We're talking income in retirement today. Who doesn't want income in retirement? Everybody does. Where do you get it? There's a lot of places. In today's video, we're going to talk about dividend paying stocks versus using an annuity for income in retirement. What's good? What's bad? What's different? Hi, I'm Antonio Cibella. Welcome to the latest video. Here we go. So we're talking about dividend-paying stocks, which is a common income strategy in retirement. A stock pays out a dividend each quarter. You can use that dividend as income. You pair together a basket of stocks, and you can utilize that to help fund your retirement versus using an annuity. And specifically today, we'll talk an income rider from an annuity. As you know from some of the other videos, lots of different types of annuities. But today we're going to compare dividend-paying stocks versus an income rider with a lifetime income guarantee. So what's good? What's bad about both of them? Well, we'll start with the dividend-paying stocks. So again, if you own stock in a company, you own a tiny little ownership share of that company, and as a result, you're entitled to profits of that company, subject to the share that you own. Companies that pay out a dividend to their shareholders, to their owners, take some of those profits and send it out each quarter as a dividend. You still own the stock. You're not selling stock to get this money. You're just receiving a distribution of profits from the company. That's a great way to draw income from a standpoint of you don't necessarily need to touch your principal because you're just taking the income distributions. It will impact the growth. If you look at dividend paying stocks and you take out the dividends that they pay, the money is certainly going to grow at a lower pace over time because you're taking those distributions rather than allowing it to reinvest. But you're of retirement age, you're looking for income, so it's fair to do that. What's a positive about it? Well, you're not touching your principal if you're just taking the income, the dividend distributions as your income. Another positive, you've got potential growth from the dividends. Over time, depending on what companies you're investing in, they could choose to grow the dividend. Negatives to dividend paying stocks. The dividend can also go down in times where the economy is not doing well. Companies can cut dividends. If their profits are down, they might cut dividends, which means a cut to your paycheck, probably at a time that you would want at least, at a time when things aren't going particularly well. Also, the payout ratio. So you can find some really high dividends out there, but it might not be the ideal investment. If you look at just a round basket of good, solid, blue chip type of companies, right now, I ran a survey of some funds. You're going to get somewhere between the high ones, low twos, maybe upwards of 3% on a dividend distribution rate. The annuity is going to be much higher than that. So if you don't need a ton of income and you can take a portion of your portfolio and put it into dividend paying stocks and then draw the income from those dividends, it could be a valuable strategy. Onto the income rider we go. So now to the annuities and the income rider. Remember, an income rider is an add-on to an annuity where they will say, we'll give you guaranteed lifetime income for either your life or the life of you and a spouse. The amount that you receive and how you receive it varies by each contract. So check out the particular annuity you're looking at for all of the specifics, but generally speaking, with an income rider, you pay a fee to the insurance company, and the insurance company will give you a guarantee saying we'll pay out X amount of income at a certain point forever. As long as they're in business and they can meet their obligations, they've got to continue to pay you. Notice I said pay a fee. If you step back and think about that, really what you're doing is you're buying longevity insurance. You're paying a fee to an insurance company to spend all of your own money so that if you run out of money, they'll keep the check coming. You don't have to worry about, I depleted my portfolio and I don't have income anymore. Subject to the income rider, as long as they can keep paying you, they have to continue to pay you even if your balance has gone to zero. So that's one of the good parts about it. It's income that is for life. For as long as you're around, you're going to get that check. The downsides to it can be expensive. You're paying a fee to gain access to your own money first before you start to access the insurance company's money. And so that expense might not be right for you. The positive to it as we compare it to dividend paying stocks, remember I said a dividend paying portfolio, maybe 2-3% annually. On an income rider, depending on your age, if you're of retirement age, 5%, 5.5%, 6% per year, you can get a pretty nice payout rate. And so if you think in terms of, remember, a base retirement financial plan, We're going to carve off a piece of money to use for income. We're going to have other assets for the other things that we're not going to draw from each month. That's how we want to structure it out. Whether that piece of money that's designed for income goes to the dividend paying stock side or the annuity side, you're likely to get a higher payout from the annuity. So let's say that you had $200,000 that's going to be your income producing bucket in retirement. If you're getting 3% in a dividend, you're getting $6,000 a year, you're getting $500 a month from the dividends from the dividend paying stocks, if that's how the numbers worked out. $200,000 at 3%, and you were taking everything monthly. Same $200,000. Let's say that you've got a 6% payout from an annuity via an income rider. So that's 6% on $200,000, $12,000. Rather than $500 a month, now you've got $1,000 a month. So you're able to draw more income from the annuity. Now you are spending down your principal. With the dividend paying stocks, you are not. With the dividend paying stocks, if you're only taking the dividend, your principal will fluctuate because it's stock, but your principal is still going to be intact, or the number of shares you own of the companies will still be intact. More to it than that, as true with most of the videos. I try to keep them relatively concise. I wanted to give you a base overview of dividend paying stocks versus using an annuity for income. If you have questions, by all means, drop me a line. Check out some of the other videos. We got lots of stuff about this on the channel. I thank you for being here. I hope you learned something, and I'll see you soon.